whenever most people start thinking about investing real estate, maybe it's passively or actively, they first time they do that, they think about single family investing. And whenever I was doing that, I was thinking about that too. But if you really want to scale and you really want to get big, you got to go to something like apartments. And many years ago, that was the first passive invested deal in the syndication that I was in. It was in apartments. And I always like to try to help bring you education on scaling your real estate business, especially with apartments. And what better person to have than somebody that goes by the name of the Apartment King, and that is Mr. Brad Sumrok. So, Brad, really cool. Thanks for joining us today. Super excited that you're here.
Hey, Dr. Jeff. I'm really happy to be here today. Super excited and to share my story. Why apartments are so attractive even right now, and they have been for 20 years. And that's how long I've been doing apartments.
Yeah, one of the things that I wanted to ask you was, we're kind of talking to somebody that's treating patients all day long, or they're going through their 9 to 5 job. They're tired, they're burned out, they're putting money in a 401k. It's up one day, it's down the next day. They don't want to work until they're 70. They're looking for a way out. And I just had a call literally an hour ago with an orthodontist in Mississippi, and he's like, "Man, I'm 44. I want to be out by 55 or less. I'm mentally, I'm checking out. And I want to be able to provide people like that education, way out." And what really intrigued me about your story was you were in the corporate world, I think maybe 16, 17 years. And you were unlike most people, because most people maybe start with a single family home, but you went from like zero education to a 32 unit apartment complex, right?
I did.
So let me back up. So what made you go from the corporate world to real estate investing? What was sort of the switch, the catalyst?
Well, yeah, I love telling this story, and it seems like yesterday. So I have not one degree, but 2 degrees. My parents never finished college, and they taught me to do all the right things: study hard, get good grades, go to college, save your money, invest in your 401k. And so I did that, and got an engineering degree, and then wanted to move up the ladder and got an MBA. And I was still trying to find my groove, kind of never really hit that groove where I was making the money I wanted to make and making the impact I wanted to make and being fulfilled like I wanted to be fulfilled. And I was always beaten to somebody else's drum, and got fired once and got laid off once, was told I didn't work hard enough or wasn't good enough and didn't come in early enough and didn't stay late enough and didn't have what it takes. And so I actually started preparing for my third degree, which was a law degree. And it's really interesting, by the way, because my younger brother followed my footsteps and became an engineer, but then he went back to med school. And to this day, he's a ER physician. So I've never been in healthcare, but my brother has been. Mm-hmm. And so, I was preparing for the LSAT, and then the Rich Dad, Poor Dad book came out somewhere in the year 2000 or 2001. And I read that book, and I got rid of all my LSAT preparation because Kiyosaki talks about the difference between formal education that will get you a job or get you self-employed. And then his second book, he talks about the cash flow quadrant, ESBI. And, a lot of people in healthcare and physicians and dentists and even engineers and accountants, they're E's or they become S's, self-employed. And so they're even working harder and they're paying more tax. And then Kiyosaki enlightened me about the other side of the cash flow quadrant, becoming a business owner and investor. So that was a big tipping point for me. And after that, Jeff, I went out and sought specialized education. Instead of going back to a law degree, I sought out real estate investing seminars because Kiyosaki talked about 2 businesses that you might want to get into. And one was network marketing. And that never resonated with me. It just didn't. Maybe it resonates with other people, but like I've been approached at gas stations by people that want me to drink their special juice or whatever. And I was like, I don't want to do that. But, he also talked about real estate. And it just seemed, well, it's real. Like real estate is real assets. And so I sought out specialized education, went to a seminar, was the most skeptical person in the room because I was educated and I felt like they were going to try to sell me something. But I tell you this, at the end of the seminar, they offered me to join a mentorship program. And here was the funny thing. I didn't want to be sold, but I wanted to buy it. It's like, did you ever go into a store where you're looking for clothes? Well, obviously you're interested because you walked into the store. But do you ever have a salesman like follow you around and it just kind of annoys the crap out of you? But if they just leave me alone, I want to buy something, right? But I don't want them pushing me. So I bought this mentorship program and I didn't tell a soul because I was embarrassed. But 8 months later, I bought my first investment property. And as you mentioned, it was not a single family rental, a duplex, a fourplex, an eightplex. It was a 32-unit building.
Where was that building located, Brad?
It was in Houston, Texas, a working class suburb. If anyone's familiar with Pasadena, Texas, very blue collar. It's a big refinery area and a lot of, mixed demographics with working class people.
Okay. Well, you had mentioned Kiyosaki and the cash flow quadrant, and we just assume everybody knows what that is. And I was actually speaking in Dallas 2 months ago to a group of periodontists, and I got everybody in the room to raise their hand for those who've ever heard of the cash flow quadrant. And out of that whole room, only 3 people had heard about it before. And it just blows me away. But I remember back to when I first heard it. That was the switch. Like, you know what? I'm nothing more than a glorified employee, even though I'm self-employed. I own my own practice. I write the checks, I hire and fire. But you know what? If Jeff's not here, money's not coming in. And I knew something had to be changed. So I wrote it back here behind us for those that can see the ESBI. So can you explain a little bit about the left side and the right side to people?
Absolutely, because I teach this in my content as well. So E stands for employee. And generally, if you're a highly paid employee, you're going to be paying 40% of your income to the taxes, not including state taxes. That's the federal tax, incremental tax bracket. And, we all know employees are, and you can be very highly compensated. Like you can move up and be like, I went from engineering to sales and I made 6 figures. And sometimes I would get 6-figure commission checks. But at the end of the day, you're still beating to somebody else's drum and at their whim for your success. And so my dream was, before I read these books, was to move into an S, because I believe that an S would be like where I control my own destiny. And S stands for self-employed. And you actually pay more in tax because you start paying not only your income tax, but now you're paying your self-employment taxes of another 15%, which when you're an employee, your company is paying that for you on your behalf. So, and again, I'm not a CPA, so maybe I'm mixing up some of the technicalities. But, so you're paying 55 to 60% of your income ultimately in taxes as a self-employed. And here's the thing, if you ever played Rich Dad's cash flow game, the game of cash flow is when you draw a card, and the card that you draw determines your job. So you could be a plumber making $2,000 a month, an engineer making $5,000 a month, or a doctor making $10,000 a month. And the higher your income is in that cash flow game, the harder it is to get out of the rat race, because when your income is high, you tend to have a bigger house. You send your kids to private schools, you drive fancier cars. So your income is high and your expenses are high. And that's why you're still sometimes not able to get ahead, because you're paying a lot in tax too. And so what Kiyosaki taught me, and I'm going to go through the B's and the I's too, is that the key to being financially independent is to build up passive streams of income, or in streams of investment income where your money works for you instead of you working for your money. And once your money that you invest is equal to your job income, then you could walk away. So like in my story, I was an E making 10,000 a month. And after about 3 years of buying apartment buildings, I had more than 10,000 a month coming in from my investments. And then I was able to walk away from my job. And so that's the message, Jeff, to the physicians and the dentists and the healthcare providers out there is, and you gave me an example of a guy that's 44 that wants to be out by 55. I would say 11 years is too long. Anybody could do this within 3 to 5 years. I was able to do it in 3. My income back then was 120 a year, you know, so if you're looking at an income now of 250, 300, 400, 500,000, well, the key is to get started right away and to be putting your money out of the Wall Street and into private investments like apartment syndications. Now, going back to that cash flow diagram, a B stands for business owner. And Kiyosaki defines it as a large business over 500 employees, but I have a different view of that. See, when I buy an apartment building, I hire a third-party management company, and I don't have to run it myself. So the difference between me buying 32 units, where I have to be very hands-on, in 250 units, where I'm very hands-off, I'm strategic, I look at the business plan. But 32 units, I was doing a lot myself. So when I bought that 32 unit building, I was still an S. When I buy a 250 unit building, I'm a B.
Okay.
Because I'm hiring third-party management and they're staffing the property, they're doing the books. I have economies of scale. And so, you know, that's how I look at being a business owner inside the apartment syndication business. And then in investors is I, and investors could be the passive investors in a syndication where they meet the person doing the syndication and they passively put their money in and earn a great return. And like I invest in my own deals too. So when I go out and do that 250 unit building, I put money in. And so my money gives me a return on my investment, which makes me an investor. But I'm also a B as a business owner because as the lead syndicator, I am taking additional compensation above and beyond my capital investment. And that's called carried interest. So I might put up 2% of the money, but I get 20% of the deal. Okay. And that's the advantage of being a B and an I. So like an I is where you put money in passively and the money generates benefits in 3 different ways. You get tax benefits, much, much better than a 401k. You get depreciation, which is a tax benefit, which saves you on tax. That's why business owners and investors pay lower tax. So business owners generally pay 10 to 20% tax and investors could pay 0. So like, I'm not here to brag. I'm just here to share and inspire and teach. My wife and I, our net income last year was $9 million and we paid 0 in tax. And it's the 4th year in a row because we invest so much of our income back into buildings, apartment buildings, and we get depreciation losses that offset the income. And the thing is, you can do this as a physician, you could do this as a dentist, you could do this as an engineer, you could do this as an accountant. And I'm not here to give you tax advice. That's your CPA's job, but I know it to be true because I'm doing it and a lot of the people I mentor are doing it. And my CPA is even doing it. My CPA is Tom Wheelwright, who is also Robert Kiyosaki's CPA, and he invests in my deals.
He was actually on the show a couple of months ago too. And I was really excited to learn that they're able now to, with his Wealthability group, to, because one of the top questions people ask me is, Jeff, if I invest like in syndications, will it decrease my W-2 income, you know, my practice income? And I usually used to tell them, hey, you know, you've got to go through the real estate professional status and that sort of thing. But he told me that they now have a method. It's a complex method, but they can still set your business up to where even if you got into a syndication, like if we were to put money in your group in one of your deals as a limited partner, there's a way that some of that depreciation that you talked about can offset that. But again, I know you're not an accountant, I'm
Yeah.
not, but I'll leave it up to them.
Yeah. And that's the message too, is that, the rule is, and again, I'm not a CPA, but this is just my understanding, right? Depreciation is a passive loss, and passive loss can offset passive income. Now, if you're a qualified real estate professional, then that changes, that depreciation loss could offset active real estate income. But here's what Tom, and if you're a really good CPA that understands this, what Tom is able to do is, if you're, say, self-employed and you run a practice, Tom is able to look at your income and help you determine how much of that income is passive from your self-employed business that you're running and how much is active. And so a portion of that is likely to be passive. And I'm saying likely because this all needs to be determined between you and your CPA. But so that's a good point, Jeff, is that it is possible for, like an example, Tom Wheelwright is a CPA. He is not a qualified real estate professional, but he invests some of his money into my deals, and he could take that depreciation and offset some of his income, because some of his income from his business is passive income, if that makes sense.
Yeah, because we're always so focused, even growing up, it's even your parents, go to school, get this job, keep going to school, be a professional to make more money. It's always about finding the deal, the profession that makes more money. It's always, how much more can I make? Can I move across country? How much can I make? How much can I make? But this changes your thinking, this diagram. It's not how much can you make, it's how are you making your money, right?
Yeah.
Because,
it's how you're making, it's how you're making your money and how much you're netting after tax.
Yeah. Because I know this, that Kiyosaki teaches this left side, the E and the S, to be the poor side, and then the B and the I, which is, he calls the rich side. And that is, you're paying less taxes, your money's working for you, you have a system in place. And the goal for us, as doctors and healthcare professionals, to get from the left side over to the right side. And once you kind of hear that, and people are like, okay, yeah, that's great, but then how do I do it? So for somebody that's out there that just saw this for the first time, or maybe they're revisiting and it going, yeah, I need to do something to get out of the rat race. What are maybe some of the steps they can go through, or to, even if they want to be an active investor or a passive investor, maybe they don't know. So what are some of the steps that maybe they can go through to get them started?
Yeah, well, the number one step is, for me, it's to get educated. And it sounds so cliche because, dentists, physicians, accountants, lawyers, professionals, they've spent so much time getting educated for their profession. But then so many people, and they continue, because like my brother's an ER physician, he's telling me like every couple of years, he's got to redo some board exams or take some continuing education and all that type of stuff. But like, he's not investing in what Wall Street would refer to as unconventional assets. But for me, that's all I invest in. I don't invest in stocks. I don't invest in bonds. I don't invest in mutual funds. Again, Robert Kiyosaki would say that's a losing strategy. And obviously right now in an inflationary market, having your money in cash or anything that's not appreciating by more than the rate of inflation, you're essentially losing money. So number one is to get educated. And there's a lot of resources out there to get educated, like your show, and online, groups and stuff like that. And then of course, for people that want, specific niche education on apartment syndications, I provide that sort of education. But it's really important that, people, like, for me, if it wasn't for me reading that book, I may have been a lawyer right now, or maybe I would have got into law and been frustrated and then done something else with my life. But the point is like, you want to sounding cliche, you want to learn how to make money while you sleep. And you want your money to work for you instead of you working for your money. And that is a paradigm shift. It was for me, probably was for you, and for anybody listening out there. That is something that you want to do. Now, if you love your practice and you're making great money at it, then that's great. You're one of the few, actually, because a lot of people make great money, but maybe they don't love it, or it's a grind and they can't see themselves continuing to do that, and actually not just do it, but love it and scale at it over the next 10 years. And what we do, Jeff, as an investor, is completely scalable. Being a passive investor is scalable. Being an active investor is scalable. So getting educated is, to me, step number one. And it also helps you make more informed investment decisions. When you're looking at an investment, you want to understand the nuances of the deal. You want to know who the syndicators are. You want to understand, is that a good market? And I always teach my students, like, when I'm looking at a deal, you want to look at three things: the deal itself, the market, and then who's overseeing the deal, like the jockey, the jockey of the horse. And so those are three things that you want to go down that rabbit hole on. And I'll also say, and I'm going to ask you in the audience, have you ever seen a deal that somebody is proposing that doesn't look good on paper? They all look good on paper, right? Every deal that someone's going to show you, hey, I got this investment opportunity, it's going to have great returns, and it's going to have a great market review, and it's going to have a great resume of the promoters putting the deal together. Nobody's going to say, hey, I'm 57 years old and I lost money in everything I've ever done, and I'll probably lose money on this one too, and my numbers are really aggressive, but please give me a chance. No, they're going to talk about how conservative the deal is and how great the market is and how much experience they have. But you got to be able to open up the hood a little bit and get to know the people and the asset class that you're going to invest in.
And I know you're a really big proponent on apartments, but these days, as you mentioned, with inflation high and we're hearing a lot of talk of a lot of the cap rates being compressed. What are your thoughts about that? As far as are you, number one, is apartments still the place to go, and number two, where are you finding deals these days because of this environment?
Yeah, well, I'll answer that in a couple of ways. So number one, I believe riches are made in the niches. Mm-hmm. And I just got back from an advanced conference that Tony Robbins puts on once a year for his platinum group. And I'm a member of that group. And it was the first week of March in Palm Beach. And he brought in 6 billionaires: Ray Dalio, Howard Marks, Paul Tudor Jones. And then he brought Larry Summers, the former Secretary of the Treasury under the Clinton administration, was there. And what they all said is, we all know we're in an inflationary environment, but every one of them said, look, we need to own property or assets that are going up faster than the value of the dollar is being eroded. And, Larry Summers said it best. He goes, if there was one asset class that I would own right now, it would be real estate that does not have long-term leases. So with apartments, we have 6 to 12-month leases, unlike retail or industrial that might have, you might sign a 10-year lease with a CVS or something where there's a 3% escalation clause. Well, apartment rents in the markets that we're in are going up 20, 30%. So every 6 to 12 months right now, we're able to raise our rents up to market and adjust our pricing because of inflation. And because of that, I'll just say this: anybody that's already owned apartments, I'm going to answer your question two ways. For those of us that already own apartments, it's been the best of times the last 18 months. In spite of what you may have heard about the pandemic and rent strikes, none of that happened in the markets that are landlord and business friendly. So anyone that's already been in, our cash flow is skyrocketing, our net worth is exponentially increasing. And then that leads to the next question is it too late? And no, it's not, because we have, I mean, I just did a virtual event, and I could give it to you and, you know, give you the link and you could share it with your listeners. But, you know, one of them in February was my 2022 apartment investor forecast. And one of them was just 2 days ago, where I talked about beating inflation right now with real estate, specifically apartment real estate. And the rents are still going up so fast, and the interest rates are still so low, although they're creeping up. And I know you just mentioned you had Tom Wheelwright on the show, but the tax laws that were passed at the end of 17 go through the end of 2022 in terms of the depreciation benefits that are available. And so those are going to start phasing out starting in 23. And the demand for rental housing right now is through the roof. Okay, the pandemic impacted the labor market, the supply chain markets. A lot of development for single family and multifamily got and is continuing to be delayed and to take longer and longer. I mean, I just went to a restaurant the other day and they said they got to close an extra day a week because they don't have enough labor to serve, and their staff is being overworked. And so here's the deal. Buying apartments, there's a window right now for 12 to 24 months where those that get in, I'm going to tell you this, I'm going to say this, and it's 100%, I believe it in my soul. If you don't get in now, you're going to regret it. You're going to have people listening to this, like, find somebody that got in and you don't, and you're going to look at those folks and say, I should have got in 2022, because there is a unique 12, and I've been doing this 20 years. I've been doing this prior to 08. I've seen the crash. I survived and thrived during the 2008 recession. I know that there's a fundamental shift in demographics right now. There's a shortage of housing. Plus, what is a working class family? Where are they going to live that makes $60,000 a year? The price of single family homes have skyrocketed. I don't know how it is in Louisiana, but like in Dallas right now, it used to be like $275,000 for a median priced home. Now it's like $375,000.
Crazy.
The credit score is, you need 660 to get a loan. You need 20% down. This is not 2008.
You're mentioning a good bit about your students, and I know that you have live events and you have training programs and that sort of thing. So what are you teaching your students as far as whenever they come in, do you recommend that they buy and hold? Do you recommend that they do some sort of value add, hold time? Tell us a little bit about that.
Yeah, so typically, like a typical hold might be like a 3 to 5 year period. Now, I just did a training for my students last night on exit strategies. And for those that own deals, right now might be a good time to reevaluate your deal, do a new 5-year projection. Like, I bought a deal in 2018. And for me to decide if I'm going to sell it, refinance it, or keep it, I wanted to know, well, how's it performing right now based on what I paid, my down payment, the current debt that I have, but let me re-underwrite it for the next 5 years based on what's happening right now with like today's vacancy, which is at an all-time low, today's rent growth, which is at an all-time high, today's cap rates that are an all-time low. And I'm looking at this deal and I'm like, man, by holding this deal for the next 5 years, I'm going to make, if I could say, boatloads of money. Right. And so I don't want to sell that deal now. And maybe I would, except I still have a $1.8 million prepayment penalty. So like, when I look at what the deal is worth now and what it's projected to be based on the fundamentals and how I'm underwriting a deal, I don't want to sell that deal. There's another deal I'm looking at where the prepayment penalty is a lot lower. So I'm looking at maybe refinancing that deal because, I bought it for 11 million. It's worth 19 right now. I could get a new loan at 14 million, pay off the old loan of 8 million and pull out 6 million tax-free, put another million back into the property to do capital improvements and hold it for another 5 years. So like, these are the things that it's important to be part of a community of investors like the one I've created, because you're not on your own to make these types of decisions.
And you're recommended the value add play to them?
Yeah, I mean,
and
look,
what is
20,
that for those that don't know? What does that mean?
Well, a value add is in simple terms, it's finding a deal that has meat on the bone.
Okay.
You know, meat on the bone could be, the industry term is like their classic units. A classic unit is a nice term for saying buying a building where the units haven't been touched in years. Like someone moves out and they paint it and carpet it and then live there for 2 years, and then they move out and they paint it and carpet it. And so that's a classic unit. But so what a value add would be to take a percentage of those classic units and upgrade them, put in upgrade flooring, upgrade countertops, upgrade appliances, upgraded fixtures, and a percentage of the residents are going to be willing to pay $100, $200 a month more. And so that's a value add. Also, value add is looking at amenities, you know, upgrading the office, the clubhouse, the fitness center, the pool, the laundry facilities, whatever amenities are on the property. By upgrading these amenities, it's like, you know, when you stay in a hotel, what's the main difference between a 4-star hotel and a 3-star hotel? Isn't the room you sleep in, it's the amenity package. It's the restaurant, the fitness center, the pool, and the hot food they serve, as opposed to the free cold continental breakfast, right? And so by upgrading amenities and services and units, that's called value add. And so that's been a great strategy. It still is, but we're kind of in a unique situation right now where we're raising rents 20 to 30% without even doing value add right now, because there's so much demand for existing rental units, and especially in the demographic of family making 50 to 70,000 a year that can't afford to buy a house.
So do you get much pushback, you know, when people maybe come to your events or your training about, maybe they have it in their mind, I want to get into real estate, but I'm thinking I need to buy a single family home. You know, they have that one home, one tenant mentality like I had when I first started. And when they come there and go, wait a minute, apartments, and they're kind of scared, you know, hearing, well, I don't have that kind of experience, I don't have that kind of money, who, you know, the expenses. And so somebody that's just completely scared at that aspect, what are you helping them to, I guess, ease their fears?
Well, here's what I would say to that. The fear usually happens after listening to a podcast like this. Maybe not the fear, but maybe the skepticism or the belief that, yeah, hey, that sounds good, but I got to work my way up. Mm-hmm. And if I could get them to my 3-day event, this might sound self-promotional, but look, this is my experience. You asked me the question. See, if I could get them to a 3-day event, they're going to be immersed with me in hundreds of other people for 3 days. It's like if you ever been to a Tony Robbins event, you know, you can listen to Tony for 30 minutes and be like, oh, it sounds good, but yeah, maybe it's too good to be true. But like, go to 4-day UPW, do the fire walk, right? Listen to Tony for 12 hours a day, be around people that are, you know, living this outstanding quality of life, and they're all drinking the Kool-Aid, and you'll come out with different beliefs. And so when people come to my 3-day, a lot of people come in skeptical. I went to a seminar 20 years ago. I was skeptical, but at the end, I was like, okay, this makes sense. You know, it makes sense. Like, I was able to warm up to the instructor. I was able to realize that what he was saying was verifiable. You know, I was an engineer and I was able to connect the dots. And that's what happens when people could invest 3 days of their life. So like, I would just say, like, you know, I hope it's not too self-promotional, but if someone's listening to this and they're like, yeah, it sounds great, I'd like to do it, but I think I need to go buy a duplex or do a house hack and buy a duplex and live in one unit and rent out the other. Look, you're a dentist. You got a wife and kids. You ain't going to go buy a duplex and rent out the other half. Like, that's the recipe for divorce and family discord. Like, don't do that. Like, you know, suspend your disbelief, come to one of my 3-day trainings, and then decide. But what you'll see is it's real, and you'll, like, most of the people then could get through that belief system.
So when somebody and we'll talk a little bit about that in just a second regarding the live events, and then you're constantly putting them on. But we'll put some links below this video if you're interested. Depending on when you're watching this video, if there's a training coming up, anyway, you can click the link below and get connected with Brad with that. So that's not a problem. But just to be real, somebody is working 9 to 5, they're treating patients, they're doing whatever. They come to your event. I'm burning out at my job, 5 years or less, I want out.
Yep.
Take that person out.
I got to be real here, because I could give a sales pitch or I could be real, and I'm going to be real, right? The sales pitch would be like, oh, I can retire anybody in 5 years or less. Well, here's the reality. It's going to depend on a few things. Number one is, do you want to be active or passive? And being active, look, everybody knows this guy, Grant Cardone, that talks about 10X. Well, when you invest with Grant, the investors don't 10X. Grant 10Xs, because Grant is the general partner. Grant is finding the deals, structuring the deals, securing the debt, raising the money, hiring the management company. That's what the active investor does, and he's 10Xing. The passive investor invests, and they maybe 2X their money. Now, 2X is a hell of a lot better than doing nothing and putting your money in a savings account and probably gambling in the stock market. And I invest passively too. That's one of my strategies. And so one of the questions would be, depending on how fast you want to get out of that in 5 years, one of the questions is, are you going to be active or passive? That's one. Okay. The other one is, how much equity do you have to invest? So like if somebody had $2 million saved and wanted to be passive, they could put 2 million into deals and make 200,000 a year, and get tax advantages, and that would grow, and they could probably get out in 5 years by being passive. If they have a big amount of money, they could dump in. But if they have less amount of money to dump in, then they're going to need to be a little bit active. But here's also the sweet spot is there's a middle ground. And I think, Jeff, you said you did this in the beginning of the show or before we went live, and it's called being a co-general partner. And being a co-general partner means that, when you're doing a syndication, there's a larger group of people that are passive. And the general partner could be one person, or it could be 2 or 3 people. So like what I see a lot of physicians doing is they're either passive because they're super busy, or they might be a co-general partner. And so, the role of the general partnership team is to find deals, underwrite deals, raise money, secure debt. And so what I find is a lot of healthcare providers could contribute to some of those things, and they keep their job, but now they're, part of the general partnership team, and they're more than 2Xing their money. Mm-hmm. And so the real answer, really, it depends. And that's the truth, because it depends on how much time that you're willing to put into it, if they want to be active or passive, and how much equity they could put in. If that's the best answer I can give you. And that's why, and you said, if they come to our program, what's next? So one of the outcomes of that program is, we have a mentoring program, and I call it a personal mentoring program because it's personalized to everybody's situation. Like, your goals and your income and your net worth and your liquidity and the time you have available is going to be different, Jeff, than somebody else. And so we're going to customize that mentorship for you to help you meet your goals. And that's how it works.
Yeah, it's kind of like somebody wants to lose a couple 100 pounds. They have the diet. They have, here's what you need to do. Here's what you need to eat. Here's how you need to train. Here's how many hours a day. And it's kind of like you're saying, here's all this stuff. It's just, now it's up to the person. Do you want to implement all of it? Do you want to do some of it? And eventually you'll probably get to your goal. It's just depending on the route you want to take. Is that pretty close?
Yeah. And like talking to a physician or healthcare practitioner's language, if I have a sore tooth and I said, hey, what is it going to cost me and how long is it going to take to fix my tooth? They got to say, well, you got to come in and see me. But I'm not saying that because, that could sound like, a bait and switch. It's like, no, look, it's very simple. It's just active versus passive. How much money are you going to invest? So like if I had $5 million, I could invest that passively and make 5-10% return right now. And if that's enough for me to live on, then I could walk away from my job. But I can make a much more dollar amount on a $5 million investment than on a $500,000 investment and on a $50,000 investment. So I get people that come to me all the time and say, Brad, I want to retire in 5 years or less, but I only have 100,000 to invest. And I'm like, well, then you're going to need to be an active investor and be on the GP team, because if you invest your 100,000 passively and make a 10% return, you're not going to, that's 10,000 a year. And then your 100 might double in 5 years. And so, doubling 100,000 over 5 years is not going to be enough to get you out. Does this make sense what I'm saying?
Mm-hmm. Absolutely. Now, you'd mentioned about the trainings and that sort of thing. And again, we'll put the links below this, but depending on when the person is watching this or listening to this, do you have any that are coming up available so we can tell the listeners about it?
Yeah, so my 3-day apartment investor training event is May 13th, 14th, and 15th. And here's the deal. I used to do this 3 times a year. I used to do it every year in March, July, and November.
Okay.
But this year I'm scheduled to only do it once. Now I might do it again in December, but right now I'm going to do it in May, and it's going to be like one big event instead of 3 smaller events. Again, May 13, 14, 15. And you know what I call the event? I call it Rat Race to Retirement, because it's my personal journey. I was in the corporate rat race for 17 years, and I was able to get out in 3 by investing in apartments. So what I teach is I share that journey, and I compare and contrast doing your own deals with your own money, like maybe doing a 3-plex or a 5-plex or a 10-plex, and how that might or might not work out. And then I talk about being a passive investor and the type of returns you could expect and the nuances and logistics that you need to learn. And then I talk about being a syndicator and how that would work. And I'll compare and contrast those 3 models. And then I also talk about finding deals and evaluating deals and funding deals, and then the steps to close a deal. But I talk about it from different perspectives, like from the passive investor perspective, from the syndicator perspective. And so what somebody could learn from coming to the 3-day event is an understanding of that business from all 3 of those angles: buying your own deal, maybe a small deal with your own money, being a passive, or being a syndicator.
Excellent. So again, that's May 13th, 14th, 15th. This is 2022, Rat Race to Retirement. Is this in Dallas?
It is in Dallas.
Okay. And I guess they can find the venue and all of that on the link that we'll provide. Is that correct?
Yeah, correct. So actually, yes, you can find out all the information on the link that will be provided.
Okay, perfect. Well, Brad, once again, I appreciate you spending time with us to educate the healthcare professionals and other busy professionals that are wanting an option to, besides the good old 401k investing.
Yeah, man. I mean, I'm just to close, I want to thank you and just like, look, man, if I move the needle on just one person or a handful of people as a result of listening to this show, then I feel like I've done my job here, because it was a big thing for me 14 years ago, or it was, well, that was 20 years ago. I was 14 years in corporate America before I read Rich Dad Poor Dad, but it was a big deal for me to like think differently and go out to a seminar. And so being able to provide that opportunity to somebody that's open to it is probably the most, the way I could impact people the best in this world. So thank you for the opportunity to be here.
Absolutely.